Canola contributes close to $30 billion a year to Canada's economy. Yet, a microscopic soil organism is now threatening that entire value chain from below ground. The pathogen is Plasmodiophora brassicae, and the disease is clubroot. Here is the trap. The resistance tool that saved yields in the short run is now accelerating long-run soil risk. The global canola seed market was valued around $8.7 billion in 2025, projected to reach about $14.6 billion by 2034 at a 5.9% compound annual growth rate. Canada alone generates roughly $14 billion in direct canola value each year. That dependence makes biological shocks, macroeconomic shocks on the prairies. This episode explains how one soil-borne protist became a structural financial threat. The first confirmed commercial case appeared in 2003 in Sturgeon County, northwest of Edmonton. It looked isolated at first, but spread accelerated quickly. By 2008, 410 canola, mustard, and vegetable fields in central and southern Alberta had tested positive. By 2026, clubroot sat embedded across Alberta, Saskatchewan, and Manitoba. Estimated annual losses now run about $500 million in Canada alone. That number is not just about yield decline in one season. It reflects persistent contamination, weaker rotation economics, and rising management costs. Once a field is heavily infected, recovery is measured in years, not months. The disease behaves like a long-duration asset impairment. Biology explains the persistence. Resting spores sit dormant in soil until root exudates from canola trigger germination. Motile zoospores then move through soil water films and infect root hairs. Inside the plant, the pathogen hijacks growth signaling and causes tumor-like galls. Those galls block nutrient flow and water uptake until plants wilt or die. Under heavy inoculum pressure, loss can reach complete failure. In severe early infection, fields can collapse to 100% yield loss. That is not common every year, but it defines worst-case economics. Even subcatastrophic infection leaves enough spores to threaten future cycles. Short-term survival decisions then shape long-term decline. Spore longevity is what turns this from a bad season into a generational problem. Decaying root galls release billions of resting spores into the soil profile, and those spores can remain viable for 15 to 20 years. A field infected in 2003 can still carry live pathogen pressure today. Prairie producers are already operating inside that long memory. Now add crop economics. Through 2024 and 2025, canola traded roughly between $600 and $694 per ton, or about $13.70 to $15.75 per bushel. Feed barley and wheat sat closer to $230 to $330. The revenue gap strongly favors canola in short-cycle planning, and that incentive is exactly what the pathogen exploits. A simple acre comparison shows the pull. At 45 bushels and $15, canola grosses about $675 per acre. At 65 bushels and $8.50, wheat grosses around $552.50. That is roughly a $122 per acre canola premium. For farms under debt and cash flow pressure, that premium is nearly impossible to resist. The issue is rotation frequency. Many operations move toward 1- and 2-year canola cycles to capture near-term margin. Epidemiologically, that is the worst timing for clubroot suppression. Financial logic at the yearly horizon directly increases biological risk at the multi-year horizon. This is the core canola paradox. Resistance genetics initially looked like the solution. After 2009, Canada deployed resistant hybrids, including 45H29, with a dominant A03 gene sourced from Mendel. Yields above 40 bushels per acre returned on previously threatened land, and the industry interpreted this as a breakthrough. But single gene resistance also creates narrow selection pressure. When inoculum runs high, around 100,000 or more resting spores per gram of soil, rare virulent pathotypes gain a strong advantage once dominant strains get suppressed. By 2013, severe breakdown had already appeared in commercial fields. Pathotype 5X emerged as a major resistance-breaking strain. The adaptation window turned out to be far shorter than expected. By 2026, monitoring had identified up to 36 pathotypes across the prairies. Of those, 19 can defeat first-generation resistance. Adaptation is no longer theoretical. It is mapped in production zones. Resistance deployment without rotation discipline can accelerate selection. The tool works, but only under the right system. Field outcomes under short rotations follow a repeatable curve. First cycle often looks acceptable and reinforces confidence. Second cycle can show around 10% yield erosion as virulent strains multiply. Third cycle often marks a full pathotype shift with losses above 50%. Fourth cycle can exceed 90% loss and render canola financially non-viable. Alberta's 12-year modeling supports that trajectory. In high outbreak, 1- and 2-year scenarios, yields fell by about 75%. Late-stage physical loss averaged roughly 18.9 bushels per acre, and gross margin deterioration reached around $76 per acre versus baseline. At that point, enterprise economics shift from low margin to negative margin risk. Independent bioeconomic work aligns with the same threshold logic. Once clubroot severity reaches about 35% on index scales, canola profitability tends to collapse. Hard red spring wheat becomes the rational substitute in many budgets. That switch protects short-term solvency, but signals long-term crop pattern degradation. Disease then changes regional production structure. There is one biological advantage available: decay. Resting spores decline along an exponential curve with an estimated half-life near 3.5 years. A 2-year break can reduce active spore load by up to 90%. But timing is critical to realizing that benefit. Alberta data across 17 fields and more than 8,500 soil samples found that spore load can rise 141% in the year after resistant canola, because decomposing roots release new spores into the profile. Planting canola again in year 2 can coincide with this post-harvest spike. The common rotation cadence places the next crop into peak pathogen pressure. What looks like a break can still be a trap. When breaks extend to 3 years or more, outcomes improve sharply. 2 or more years away from resistant canola can reduce resting spores by about 95%. Alberta trials showed a 3-year break lifting yields by about 19 bushels per acre versus 2-year cycles. Quebec studies reported gains between 32 and 76% after a 2-year break. Economic models translate those agronomic gains into return metrics. With susceptible cultivars, 3-year rotations delivered about $140 per hectare in annual net advantage. Even with resistant varieties, the advantage held around $56 per hectare. Longer rotations can outperform once disease pressure is priced correctly. The challenge is surviving the near-term revenue sacrifice. That sacrifice is why adoption lags. Asking growers to plant less high-price windows is like asking a winning trader to cut position size. In Alberta hotspots, behavior confirms this incentive bias. Leduc County saw total cropland decline 4.24% between 2016 and 2021, while canola acreage rose 8.12% to nearly 88,000 acres. Financial signals ran stronger than biological warnings. By 2024, University of Alberta surveys found clubroot in 47 counties across 307 canola crops. Out of 691 fields sampled, 167 new positives appeared in fields with no prior detection history. Spread and acreage intensity are moving together. Management progress exists, but pressure keeps expanding geographically. Geopolitics adds a second layer of risk. In March 2019, China revoked canola export licenses for Richardson International and Viterra. Officially, the issue was blackleg detection, but broad market interpretation linked the move to wider diplomatic retaliation. Between March 2019 and February 2020, Canadian canola prices ran about 3.6% below expected levels. Estimated producer damage from that episode ranged between $1.34 billion and $2.28 billion Canadian dollars. The lesson landed hard. Trade exposure can erase agronomic gains quickly. And then another shock arrived. In September 2024, China opened an anti-dumping probe on Canadian canola amid broader tariff tensions involving electric vehicles, steel, and aluminum. Basis reacted immediately. Farmers lost an estimated $140 million in weeks, with cumulative losses running up to about $800 million versus peak pricing. Diversion options were constrained because the EU applies strict zero-tolerance standards for GM traits in many channels. Canadian canola is predominantly transgenic, which means tight access limits. Export redirection only works within narrow use cases. For 2025 to 26, EU-bound volumes were estimated around 2 to 4 million metric tons, mostly tied to biodiesel use. Australia captured premium share in Europe through largely non-GM positioning. Canada responded by expanding domestic crush to reduce raw export dependence, which stabilized some flows but created new concentration risk. Canadian processors crushed a record 11.6 million tons in 2025, marking a third straight annual record. Domestic crushers now absorb more than 50.5% of total canola supply. That buffers some external shocks, but shifts exposure downstream. By 2024, about 76.7% of Canadian canola oil exports went to the United States, all linked to renewable diesel demand. That dependency showed up clearly in early 2026. Canola futures climbed above $730 per ton during Hormuz tension escalation, then quickly corrected below $720 as risk expectations eased. The move came from energy geopolitics, not farm fundamentals. Unhedged producers faced rapid mark-to-market swings completely outside agronomic control. Biofuel-linked premiums proved highly reversible. On the genetics side, the industry is now in an arms race phase. Second-generation cultivars stack multiple resistance genes across different chromosomes, raising the evolutionary hurdle for the pathogen versus single-gene defenses. Under heavy pressure, stacked lines have kept disease severity index below 3% in repeated cycles. That is strong performance, but not a standalone solution. Commercial pipelines are scaling that approach. BASF's Invigor portfolio uses stacked clubroot genetics. Pioneer's Protector line with CR6 targets pathotypes including 2F, 3H, 5X, and 3A. Brett Young's Defender combines multigenic resistance with herbicide tolerance and blackleg defense. Breeding is no longer about one trait, it is about defensive packages. Research breakthroughs suggest further acceleration. In 2025, NR Gene introduced donor lines with resistance to multiple virulent pathotypes, including 5X. Under severe pressure, those lines reported 0% incidence, while nearby commercial checks exceeded 74%. Earlier in 2023, researchers identified the Wei-Tsing calcium channel as a critical mechanism, and in 2024, CRISPR insertion of RCR1 into elite germplasm opened a marker-free pathway for broader defense deployment. Genetics still needs field hygiene to hold. Equipment sanitation remains one of the cheapest high-impact controls. Effective protocols combine mechanical cleaning, 2,000 to 3,000 psi pressure washing, and 1 to 2% sodium hypochlorite disinfection. Compliance stays uneven because each event can cost about $300 to $1,500 in labor and downtime. But avoided loss on a 1,500-acre operation can preserve more than $114,000 in annual gross margin. Soil chemistry offers another lever. University of Alberta trials found hydrated lime reducing clubroot severity by 35 to 91% in susceptible cultivars. In resistant varieties under high inoculum, visible symptoms were eliminated entirely in trial conditions. Full-field broadcast rates are often too expensive to be practical. Economic value appears in targeted hotspot treatment. Pelletized lime near $530 per ton can push full-rate costs above $2,500 per acre. That is prohibitive at broad-acre scale. But applying lime to entry points in low-lying wet zones can interrupt early colonization at manageable cost. Precision placement converts an impossible strategy into a viable one. Precision tools make that targeting possible. Multispectral and hyperspectral drone scouting can detect early infection at over 80% accuracy, with typical monitoring costs around $3 to $5 per acre across repeated flights. Early detection of even a 1-acre hotspot can prevent much larger future losses. a small scouting expense protecting tens of thousands in subsequent revenue. Biological controls are also improving. Musgrove's Terra MG, derived from mustard seed meal, shows 98.5% spore control in greenhouse studies. Fieldwork reported around 95% reduction in spore populations. Canadian trials observed yield gains up to 7 bushels per acre, translating into approximately $91 to $100 per acre in additional revenue from treated plots. Research funding now reflects the scale of threat. A $17 million canola agriscience research cluster covers 2023 to 2028, supporting 17 projects on yield, resilience, and disease management. Regional groups added $1.25 million to University of Alberta work led by Drs. Steven Strelkov and Xiaofang Huang, mining 30 brassica lines and wild relatives for new resistance genes. The Canola Agronomic Research Program committed $3.4 million to 11 projects, including AI-based pathotype identification. International programs are moving in parallel. Australia can fund up to $3 million per project through cooperative research center structures focused on AI surveillance. Europe is redesigning biocontrol regulation with green priority lanes, targeting approval timelines under 3 years and unlimited approvals for low-risk biologicals. Regulatory speed is becoming a competitive variable in disease management. Governments also activated financial backstops. Canada's Sustainable Agricultural Partnership is a $3.5 billion 5-year framework. For 2025, AgriStability doubled its payment cap from $3 million to $6 million and raised compensation from 80% to 90% for severe margin declines. The Advance Payments Program doubled the interest-free limit for canola producers to $500,000. Projected to save about $36.3 million in interest for more than 7,700 farmers. A separate $370 million biofuel production incentive aimed to expand domestic renewable diesel and sustainable aviation fuel refining. These supports buy time, but they do not remove the core biological constraint. The sector is still borrowing from future soil health to sustain present liquidity in many regions. If rotation discipline does not improve, subsidies can stabilize cash flow while underlying risk keeps compounding. This is why land value risk is no longer hypothetical. Prairie farmland values have climbed about 9.3% on average, but that valuation assumes flexible crop optionality. In areas with endemic resistance-breaking clubroot, rotation can narrow to wheat, barley, and field peas. That compresses expected future cash flow and lowers net present land value. The apparent canola premium can become a long-term anchor. The industry stands at a true crossroads. Energy transition demand is pushing canola volumes up, while soil biology pushes rotational limits down. Emergency aid, trade diversion, and breeding gains can delay damage, but none replaces system discipline. Durable stability requires longer rotations, sustained genomics, targeted field hygiene, and resilient domestic processing pathways. The most profitable crop above ground can still be the most destructive force below it. What happens next depends on whether decision horizons change. Most farm budgets operate season by season, while clubroot dynamics unfold over multi-year biological cycles. That mismatch rewards aggressive planting in the short run and punishes land productivity in the long run. If rotation discipline is delayed, costs reappear later as yield loss, weaker collateral, and lower option value on the same acres. Clubroot is not only an agronomy issue, it is a time horizon issue. Credit systems can either accelerate or reduce that risk. If lenders and insurers continue pricing only current year margins, farms get pushed toward behavior that raises long-run pathogen pressure. If underwriting starts rewarding verified rotation compliance and hotspot management, capital can reinforce biological resilience instead of eroding it. The data to support that shift now exists through soil sampling, scouting records, and treatment logs. Financial design is a lever, not just a background condition. Public policy also needs to separate emergency relief from structural transition. Payment caps and temporary liquidity programs help farms survive shocks, but they do not by themselves lower spore trajectories. Structural gains require persistent support for breeding, sanitation adoption, precision detection, and practical rotation pathways that farms can finance. Without that architecture, subsidies can mask deterioration while underlying risk compounds. Stability comes from changing system behavior, not only replacing lost cash flow. The canola paradox is now a global warning, not just a prairie warning. Any high-value monoculture facing a persistent soil pathogen can repeat the same cycle of short-term gain and long-term biological debt. The lesson is straightforward. Resilience must be engineered across genetics, finance, and field operations at the same time. If one layer advances while another stalls, the pathogen eventually exploits the gap. Long-term food and fuel security will depend on whether this integration happens before the next resistance wave arrives.